Let's bring in Nicholas Wealth Management President David Nicholas. David, before we get into buy the dips, I was checking out, and I want to kind of share this with the audience because you say there's good news and there's bad news. Let's start with the good news that you're seeing. No credit, not credit related, what's happened with this market, and, of course, lower rates being good for mortgages and consumers.
Yeah, that's right. I mean, again, what we saw last week with the sell-off is this isn't a credit-driven crisis. That's a good thing. We got to make that distinction. And we've seen rates come down. Charles, that is good for the consumer. And if we're thinking about a slowing economy, we want consumers to have more money in their pocket. So if anything, this little fear or whatever, the contagion of the yen-Japanese carry trade, I think was positive with it, brought yields down. It did the work of the Fed without them actually doing it, Charles.
On the bad side, big geopolitical risk, which, by the way, seem to get bigger every single day. Right, they're not coming down at all. Lack of strong leadership, and VP Harris surging in the polls has been devastating for the Russell 2000 and maybe other niches. When you say lack of strong leadership, though, is that relative to the stock market?
No, I think that's our geopolitical leadership. I think when you look at President Trump, and Charles, I've been all over and traveling. Recently in the summer, we were traveling in Europe. The resounding theme was they may not like Trump overseas, but what I kept hearing was he's a strong leader. He's a strong leader. Politics is a dirty game. I would love a nice guy to be elected, but the problem is when you're dealing with world leaders like Putin, President Xi, we need toughness. I think Kamala Harris is a risk to that, to those, and I think it emboldens those leaders. So weak leadership, I think, causes concern, which is why I think we're seeing heightened volatility. The Olympics are over. We'll see what Iran does, but I think they're waiting, unfortunately, to make a move on Israel. That adds geopolitical risk, Charles.
Now, I know you're champing at the bit about buying on the dips, and I just wanted to share something in the audience, right? Going the dip buying, to me, it's like a rubber band, right? The further we get stretched, more often than not, the bigger the rebound, right? So we had a huge pullback here. The rebound was nice. Look at that gargantuan rebound in the late 2018. The rebound was huge. So more recently, we've had a 5% and 8% pullback, and hence the rebounds have been just really, short. Do you wait for a bigger dip, or do we buy this dip here?
Yeah, Charles, this is the million-dollar question. And I think a lot of it is the speed, which is what you're talking about. I'm glad you brought that up, is when I saw how quickly this wasn't a 5-month where the market slowly dipped down. This was a 6-7 day event where we saw very real selling pressure in the NASDAQ and the S&P. And when I look at the data, the speed at which the market sells off, you normally see a recovery that is usually equal to that. But even a 5 to 10% pullback, the recovery is usually 1.5 to 2 times the pullback amount over the next 6 months. So I think if you look at the VIX spike where it was historically, this is still a good, NASDAQ's down 10% still from its peak. This is, I think, a good time to still put money to work.
All right, so let's talk about some of the larger cap buys you like here. It's sort of the usual suspects, right? NVIDIA, Apple, Palantir, Meta. Do we add a caveat for the audience that these are volatile, high beta names? One of the problems I have with a lot of investors, retail folks who've just come into this market, David, and you're having it, must have it as well, is that these things feel great when they go up big every day, right? They're up 2%, 3% every day. Then all of a sudden they get back 4%. How do you caution folks, if you're going to buy these names, buckle up?
Yeah, that's it. We're either an investor or we're a trader, and I get the short-term trading. It can make a lot of sense, but these are high beta names. They have a high standard deviation. Look, if you want good returns, you got to have stocks that have high standard deviation, means higher risk. So you're going to get that in these big large cap names. But again, if I'm getting the deviation, if I'm getting a variance of returns, I see that's where I'm going to get growth. And also, there's just not earnings breadth. If I want to put money to work, where's the earnings? Where's the growth? It's in these big names, Charles. The top 10 names in the S&P 500, that's where the earnings are. If you just look for the third quarter, it's projected at 15% earnings growth. The bottom 490 companies of the S&P are only predicting 5% earnings growth. So if I want to put money to work, I'm going where the big names are still driving earnings.
Yeah, some folks are, I think, confusing the fact that maybe earnings growth won't be as fast as it was before, which was mind-boggling once in a lifetime. But to your point, it's going to be robust enough that you want to own these names. Hey, David, I got to go, but I will share with the audience for the Russell 2000. You think a good way to play it is VTWO, right around a 50-day moving average, maybe breaking out there, can regain that momentum. I miss you, my man. It's great seeing you. Let's talk again soon.
Always great to be back, Charles. Thank you.